The Magnificent Seven stocks are 7 of the largest tech-related companies in the US stock market. These companies have driven a significant portion of the S&P 500's gains in recent years due to their size, innovation, and dominance in their respective industries. In this video, I'll be going through all of the Magnificent 7 stocks to see which ones are good buys right now and which ones aren't so great buys. And just to make things a little more interesting, I'll also be putting them into a tier ranking ranging from which I think are undervalued currently, which are fairly valued, all the way to which I think are a sell. So without further ado, let's first start off with Apple. Apple is the largest company in the US in terms of market cap, and for very good reasons. It has a track record of strong execution, industry-defining products, and enjoys several moats such as brand loyalty, strong monopoly, high switching costs, barriers of entry, and economies of scale. However, despite that, if you look at its revenue, it has actually stayed rather flat since 2022. Likewise, their earnings per share also haven't really been growing at all. One of the biggest reasons for this is that their iPhone sales, which drive around 50% of their revenue, have not been growing. Apple is also facing tough competition in China, where it derives almost 20% of its revenue from. During the last 3 months of 2024, Apple overall sales in China has declined by 11.1%. This was the largest drop Apple has seen in China since the first quarter of 2024. Not just that, Apple is also caught right in between the trade war crossfire, and analysts are now warning that Apple could see their earnings per share drop by as much as 15% if they don't adjust their pricing. Though, this number could potentially be even higher due to the increased tariffs. However, not everything is bad news. Apple Services business has been steadily gaining momentum and is now one of the company's most promising growth drivers. This is a high-margin business and plays a key role in boosting Apple's overall profitability. Just a few years ago, services made up around 18% of Apple's total revenue. Today, it accounts for 21%. This highlights the strength and potential of Apple's ecosystem beyond hardware. Apple is also sitting on a large cash pile, which gives them the flexibility to do all kinds of things, such as share buybacks to boost their earnings, invest into R&D, make strategic acquisitions, as well as weather any storms that may come their way. So, what is the valuation for Apple? Based on the commonly used PE valuation method, Apple's current PE ratio is at 32, which has higher than it has been in 67% of the past 5 years. This indicates that it is not cheap. Similarly, if you switch to PB and PS, the results remain similar. And if you check websites like FinWiz, FinChat, and GuruFocus, all of them are forecasting that Apple's earnings per share will grow by around 10% over the next few years. So if you were to put that into GuruFocus DCF calculator, you will see that Apple is currently quite overvalued. And even if you were to use Apple's 10-year historical growth rate of 15%, the current stock price is still a little too expensive. Because of that, I will put Apple in the very overvalued category. Quick pause. If you want to assess whether a company is worth investing in, a great place to start is the moomoo app. With moomoo's smart investment tools, you'll find a wealth of useful information. For example, as I've shown in Apple's case, you can get a quick overview of the company's valuation level with moomoo's company valuation tool. With this, you can quickly assess whether a company's current stock price is cheap or not. For value investors, this is an essential information to know before investing. Besides that, you can also check out analyst ratings to see what Wall Street analysts think about the company, alongside with detailed explanation of their ratings as well as their track records. For additional insights, you can also check out Morningstar ratings. This is a paid feature, but is available for free on the platform. It's one of the main sources I rely on for doing investment research. And if you are into technical analysis, moomoo's Smart Analysis tool is a game changer. It helps you track current market sentiments, money flows, and results from various technical indicators, along with potential buy and sell points. New users who sign up to Moomoo Singapore will get to earn up to $820 worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Next up, we have Google. Google is a fantastic business that has consistently grown their revenue for years. And even though there's the whole fear about LLM taking away Google's search advertising business, to date, we haven't seen that happening in any significant way, as their search business is still growing strong. Due to Google's strong pricing power, they are able to raise ad costs without losing advertisers. Besides search advertising, Google's cloud business has also been seeing strong growth of around 30% year over year. If this momentum continues, Google Cloud could become one of its main growth drivers in the coming years. Meanwhile, Google has been heavily investing into the AI space and cloud computing and expects to increase their investments even more this year. These investments are already showing signs of growth, and as businesses and consumers continue to adopt Google's AI-powered solutions, Google's leadership in this space will continue to drive revenue growth. So, what is the fair value for Google right now? Google's PE ratio is currently at 20. This falls into the 10th percentile when compared to the past 5 years. This means that Google's valuation is lower now than it has been 90% of the time over the last 5 years. Meanwhile, analysts put Google's earnings per share future growth rate to be around 13% to 16%. So if I just take the average of 14%, this will put Google's fair value to around $165. Based on Google's current share price, it will mean that Google is currently fairly valued. Though, this is just a conservative estimate, because if I were to use their past 3 years EPS growth rates of 17%, Google's fair value would be closer to $202, making this a rather attractive investment. Nevertheless, because I want to be conservative here, I will still put Google in the fairly valued category. Next, we have Meta. A few years ago, when Meta announced that they were losing users for the first time in history, many investors thought that Meta was on a decline and its best days were over. Since then, Meta has defied all odds and their daily active users has grown by another 500 million. So, Meta is not only not on a decline, but they have grown larger since then. Their financials have also been growing steadily. Revenue is growing, net income is growing, and even their free cash flow is growing, despite them investing increasingly amounts of money into their Metaverse project and AI. While these ventures are still in the early stages, there are signs that these investments are starting to pay off. For example, Meta's AI has helped improve its advertising platform and recommendation system, which has led to more user engagement and better ad experience. One good proof of that is that even though Meta's ad impressions have gone down year over year, their average price per ad has gone up, and advertising revenue has gone up as well. So, is Meta overvalued or undervalued right now? Looking at Meta's PE ratio, the current level is cheaper than 77% of the time over the last 5 years. Meanwhile, Meta's earnings per share has grown by around 20%, whether you are looking at the past 3 years, 5 years, or 10 years. However, analysts think that this could slow down to around 12 to 13% over the next few years. So, given that a recession could happen and negatively affect Meta's revenue, I wanted to be a little conservative here and assume that Meta's earnings per share growth rates will only be around 15%. This puts Meta fair value to be around $540. Because of that, I will put Meta in the overvalued category. Moving on, we have Amazon. Amazon is an incredibly diversified, high-quality company with many of its business segments enjoying high margins and strong double-digit growth. Its AWS business holds the largest market share in cloud computing, while its retail e-commerce business commands around 40% of the US market, and it benefits from significant operating leverage across its logistics network, data centers, and infrastructure. Despite that, one of the main concerns investors have is with Amazon's heavy capital expenditure, which can sometimes lead to little or even negative free cash flow. Though, this isn't due to a lack of financial strength, but rather is a deliberate strategic choice made by Amazon. Amazon is not focused on maximizing their free cash flow. In fact, if the company wanted to, it could easily generate significantly higher profits and net income than many investors might anticipate. Instead, Amazon opts to reinvest heavily into its own growth, such as doubling its fulfillment network, expanding its data center footprint, as well as enhancing its AI capabilities. These initiatives will not only support Amazon's long-term expansion, but they also have the potential to generate substantial returns on its investment. So Amazon is a very high-quality company that I'm quite confident will continue to thrive and deliver long-term value to shareholders for many years to come. But what is Amazon's fair value today? Amazon's current PE ratio of 33 is rather close to its historical average. This indicates that it isn't cheap nor expensive. Meanwhile, analysts expect Amazon's earnings per share to grow by 18% to 20% over the next few years. So if we just use an average growth rate of 19%, this will put Amazon's fair value to around $165, which is lower than its current share price. Because of that, I will put Amazon in the overvalued category. Next up, Microsoft. I don't think it's an understatement to say that Microsoft is easily one of the highest quality businesses on this list. Ever since Microsoft transitioned its core offerings such as Office and Windows to a subscription-based model, the company has seen strong growth in both revenue and net profit. Its cloud computing platform, Azure, has also been steadily growing and is well positioned to capitalize on the secular growth trends in cloud adoption and AI computing. Additionally, most of its business segments are recession-proof thanks to the essential nature of its products and services. Its moats are exceptionally strong as well, making them difficult to replicate or disrupt. For example, the company's software ecosystem built around Windows, Office, and Microsoft 365 have created a network effect that businesses and consumers continue to rely on. These products have become essential for personal computing, productivity, and collaboration, ensuring Microsoft remains integral to the global economy. Microsoft's cloud services also have been indispensable for businesses of all sizes, and Azure in particular is well positioned to benefit from the accelerating shift to cloud computing. This enables Microsoft to capture even more market shares as companies continue their migration to the cloud. And just like many other hyperscalers, Microsoft have also been strategically investing in artificial intelligence, which may further strengthen its position in the rapidly evolving tech landscape. So, what is Microsoft's fair value today? Its current PE ratio shows that it is cheap when compared to its historical average. Meanwhile, its earnings per share is expected to continue growing by 12 to 14% in the coming years. So, based on the estimates, Microsoft's share price is definitely a little on the high side now. Because of that, I will also put Microsoft in the overvalued category. Next, we have Nvidia. Nvidia is arguably the biggest beneficiary of the whole AI revolution. Thanks to its leadership in GPU technology and surge in demand for AI-driven applications, machine learning, and data processing, Nvidia has seen explosive growth, whether it's in terms of their revenue, net profit, and free cash flow. Unsurprisingly, everyone wants a piece of that success. As the AI boom continues to accelerate, competitors like AMD, Intel, and even Nvidia's own customers are vying for their share of the rapidly growing AI market. However, while these companies are working to develop their own alternatives, Nvidia's strong technological lead, extensive ecosystem, and dominance in high-performing computing give it a significant edge that's tough to compete with. So, how overvalued or undervalued Nvidia is right now? Its current PE indicates that it is very cheap when compared to its historical average. Meanwhile, analysts are currently expecting Nvidia's earnings per share to continue growing at an incredibly fast rate of 28% to 38% over the next few years. However, because the semiconductor industry is inherently cyclical and given the heightened risk of potential recession and the ongoing impact of the trade war, I wanted to be a little more conservative. With that in mind, let's use a lower 25% growth rate. Even with these cautious estimates, Nvidia still appears to be undervalued at its current price. Because of that, I will put it in the undervalued category. Lastly, we have Tesla. Depending on which camp you are in, Tesla is either very overvalued or still grossly undervalued. However, the one thing that is true is that Tesla's fundamentals have slowed down in the recent few years, whether it's in terms of their revenue, net income, free cash flow, and margins. Tesla's recent deliveries have also dropped by 13% at a time when other EV manufacturers are experiencing strong growth. This decline can be attributed to Elon Musk's political stances and controversial public actions. However, one good news is that Elon Musk will be stepping down from his government's position. While this move won't immediately resolve the brand damage Tesla has faced, it should help to reduce the intensity of the controversy surrounding him and the company over time. Then, as Elon Musk refocuses his attention on Tesla and its core business, I believe the company can regain momentum and work towards overcoming the challenges that it's currently facing. Because let's face it, even though Tesla is still technically a car company, it is well positioned to benefit from many of its verticals in the years to come, whether it's in energy, robotics, and autonomy. So, what is Tesla's current fair value? Looking at its PE ratio, it is hard to say that it is cheap when compared to its historical average. Meanwhile, analysts are currently expecting their earnings per share to grow by 20 to 26% over the next few years. But for argument's sake, let's just use an even more bullish estimate and say that Tesla could grow their earnings per share by 35% over the next few years. Even with this optimistic growth estimate, Tesla's share price still appears to be significantly overvalued. So, while Tesla is a very promising company, unfortunately, I will still classify it in the very overvalued category. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.